Morning everyone. We are the group 2 and we are about to report the financial instruments. Financial instruments is a monetary contracts between parties, the buyer and the issuer. They can be cash, evidence of ownership, interest in an entity, or a contractual right to receive or deliver in the form of currency, debt, equity, or derivatives. One of the financial instruments is the bond. Bond is a form of loan issued by a corporation or a government to raise capital. It is also known as fixed income security. Bonds are issued by companies, municipalities, states, and sovereign government to finance projects and operations. There are three variables characterized by a bond. The three variables characterized by a bond are the par value, the coupon rate, and the maturity date. Par value or face value is the amount that the issuer pays at the time of maturity. Coupon rate is the annual income an investor can expect to receive while holding a particular bond. Maturity date is the date a bond matures and the bondholder gets paid back the principal bond amount. For example, Jessica bought a 1,000 pesos bond with a maturity of 2 years at a fixed coupon rate of 5%. In 1 year, she will receive a 50 pesos coupon bond. In 2 years, when her bond matures, she will receive 1,050 pesos back, which includes her par value of 1,000 pesos.
Good morning, ma'am. Good morning, classmates. I am Lloyd R. Balinsua, and I am going to discuss the topic of equal provision and a covenant. So first, what is equal provision? Equal provision is a clause in the contract for a bond known as the bond indenture. It allows its issuer to pay off the bond before its maturity date. This is also known as the redeeming the bond. So, for example, you bought a 10-year bond, 10 years bond with equal provision. The company that issued the bond could potentially redeem it from you in 5 years, collecting the bond back and paying you even though the contract or the term is not yet expired. And also, equal provision is typically an optional clause in the bond indenture. An issuer can exercise it but doesn't have to. Individual bonds will specify how much the holder receives if an issuer calls it bond. Typically, the issuer will pay equal price and all accrued interest, and in some cases, they will pay in additional premium. In covenant, a covenant in accounting is a promise just like any other covenant. In accounting, covenant deals with financial promises. A company enters into a covenant as part of an agreement with an investor or lender. It agrees that its financial ratios will remain at specified levels. If the covenant is broken, the company can be subject to a number of consequences. So, in the broadest sense of a covenant, it is a promise or a agreement or contract between two parties. As part of the covenant, two parties agree that certain activities will or will not be carried out. And in covenants in finance, most often relate to terms in a financial contract such as loan, document, or bond issue stating the limits at which the borrower can further lend. So, covenants in religion often convey the binding relationship relationship between deity and humanity. So, regarding business, covenants are most often represented in terms of financial ratios that must be maintained, such as maximum debt to assets ratio or other such ratios. Covenants can cover everything from minimum dividends payments to levels that must be maintained in working capital to capital K employees remaining with the firm. So that would be all about the call provisions and the covenant. Thank you.
So, good day, ma'am. I am Kenneth C. Ibanez, your student from 2FD, major in financial manager. So, my report is all about right in bankruptcy, secured creditor, and bonds as an investment. So, as I start, what is right in bankruptcy? So, rights in bankruptcy are all creditors have the right to be heard with regard to liquidation of the debtor's non-exempt assets in Chapter 7 and with regard to the debtor's repayment plan under Chapter 13. So, all creditors are also entitled to challenge the debtor's right to be discharged. Then, not all creditors are treated equally in the bankruptcy case. So, in order to complete the officially bankruptcy forms that make up the petition, a statement of financial affairs and schedules, the debtor must compile the following information. So, a list of creditors and the amounts of nature of their claims, then the source amount and frequency of the debtor's income, and a list of all the debtor's property and detailed list of debtor's monthly living expenses. An example are food, clothing, shelter, utilities, taxes, transportation, medicine, etc. Then the second one is all about secured creditor. So what is meant by secured creditor? So secured creditor is any creditor or lender that associated with an insurance of accredited product that is banked by collateral. Then secured credit products are backed by collateral. In the case of a secured loan, collateral refers to assets or the pledge as security for the prepayment of that loan. Okay. Then the last one is the bond as an investment. So by the way, what is a good bond as an investment is a good investment. So bonds yields have meaningfully increased, providing investors an opportunity to earn decent income. Then we expect inflation to be around 3.5% by the end of 2023, and the US treasurers through the 10-year maturity are yielding more than that. So that means their inflation adjusted or real yield could turn positive. So that's all. Thank you.
So in this video, I will discuss about the bond ratings and junk bonds. So first, I will discuss the bond ratings. Bond ratings. A bond ratings is a way to measure the creditworthiness of a bond which correspond to the cost of borrowing for an issuer. This ratings is typically a letter grade to bonds that indicates their credit quality. A bond ratings is a letter-based credit scoring scheme used to judge quality and creditworthiness of a bond. The higher bands the ratings, the lower the interest rate. It will carry or else equal. So next is a junk bonds. Junk bonds are bonds that carry a higher risk of default than most bond issued by corporations and governments. A bond is a debt or promise to pay investors interest payments along with the return of invested principals in exchange for buying the bond. Junk bonds are also called high-yield bonds, since the higher yield is needed to help offset any risk of default. A junk is a debt that has been given a low credit ratings by a ratings agency, below investment grade. As a result, the bonds are riskier since chances the issuer will default or experience a credit event are higher. Because of the higher risk, investors are compensated with a higher interest rates, which is why junk bonds are also called the high-yield bonds. A high-yield or junk bonds is very similar to a regular corporate bond. Both represent debt issued by a firm with a promise to pay interest and to return the principals at maturity. Junk bonds are differ because of their issuers Poor credit quality.
Common stocks. Common stocks are essentially shares of ownership. These stocks are the types of most people invest in on the stock market or public exchange. When you own a common stock or a share, you may eligible for dividends. And if the company does well, you may get a part of that profit. Additionally, shareholders can vote on big company decisions. For that reason, common stocks have a lot of value outside of the money. If you can help decide who's running a large company, you have the power to make some real-world changes. However, some companies may also sell common stock that's not eligible for voting rights. For example, voting and non-voting. Non-voting common stocks are still valuable, though, because these are publicly traded assets. There is still room to turn profit from selling shares if a company does well, because common stocks are publicly traded. Practically, anyone can invest in them. Corporate finance professionals, such as investment bankers, may use common stock prices on the exchange as an indicator of the company's performance. Additionally, one aspect of investment banking is bringing private companies through the essential public offering, making the company public. Once the company is publicly traded, it will likely issue common stock. Shareholder control means the power effectively use to direct the corporate activities and guide the operation of the company's governing bodies, either directly or indirectly. In practice or by law, a person or group of persons will be presumed to have control if they are bound by a shareholders agreement or under common control, holding shares that have granted them the absolute majority of votes of the shareholders who attended the last 3 shareholders meetings. Regardless of whether they hold title or shares that grant them the absolute majority of the company total voting shares. And even if you own shares in the company, you can't necessarily fully control its future. You may need to take proactive steps to prevent yourself being left at the mercy of those who own the greater percentage of shares.
Hello everyone, I'm gonna discuss 2 topics for today, and the first topic is cumulative preferred. What is cumulative preferred? Cumulative preferred is a type of preferred stock with a provision that stipulates that if any dividend payments have been missed in the past, the dividends owed must be paid out to cumulative preferred shareholders first. There are 2 types of preferred stock, the cumulative and non-cumulative. The cumulative preferred stock must pay all outstanding dividends or dividends in arrears before it can pay any dividends to owner of common stock. Dividend in arrears are contractually required dividends for prior years that have not been paid to the preferred shareholders. And non-cumulative preferred stock requires only the current year's dividends be paid to the preferred shareholders before the common shareholders receive dividends. That's all for topic 1, the cumulative preferred. And let's proceed to topic 2, the financial markets. Financial markets, a place that provides an avenue for the sale and purchase of assets such as bonds, stock, foreign exchange, and derivatives. There are some types of financial market, which are the stock market, bond market, commodities market, and derivatives market. Stock market trades shame of ownership of public communities. Bond market offers opportunities for companies and the government to serve money to finance a project or investment. So that's all for topic 2.
Good morning everyone, I'm Jessica Zapico, Section 2FD4. My topic is all about private placement or public issue. For me, private placement is a sale of stock, shares, or bonds to pre-selected investors and institutions rather than publicly on the open market. It is an alternative to an initial public offering or IPO for a company seeking to raise capital for expansion. Private placements are regulated by the U.S. Securities and Exchange Commission under Regulation D. Investors invited to participate in private placement programs include wealthy individual investors, banks and other financial institutions, mutual funds, insurance companies, and pension funds. One of the advantages of private placement. A private placement is a sale of securities to pre-selected number of individuals and institutions. Private sales are now common for entire apps as they allow the company to obtain the money they need to grow while delaying or foregoing an IPO. Public issue, the management of securities of the corporate sector offered to the public on a regular basis and existing shareholders on a right basis is known as public issue management. In other words, the management of issues for raising funds through various types of instruments by companies is known as issues management. And that's all. Thank you.
Good morning everyone. I am from the Group 2 and I'm going to report about organized exchanges and over-the-counter markets. Public issues trade on two types of markets, organized exchanges and over-the-counter markets. Organized exchanges such as New York Stock Exchange and the American Stock Exchange are centralized trading locations that maintain active markets in hundreds of stocks and bonds. Stockbroker members of the exchange transmit clients' buy and sell orders to specialists on the floor of the exchange who attempt to match buyers with sellers. Specialists may buy or sell securities for their own accounts, but more often they act as agents pairing buyers with sellers. So the term organized exchange means a trading facility that permits trading by on or behalf of a person that is not an eligible contract participant or by persons other than that on a principal-to-principal basis or has adopted directly or through another non-governmental entity. Over-the-counter markets are much more informal. Any brokerage house anywhere in the country can create an over-the-counter market for a stock or a bond by quoting a bid price at which it will buy the security, and a higher ask price is the broker's revenue. In return, the broker must keep an inventory of the security and must frequently trade for her own account to maintain an active market. Most well-known equity securities trade on organized exchanges, whereas the share of smaller regional companies and a great many bonds trade on the over-the-counter market. The over-the-counter market, commonly known as the OTC market, is where the securities that aren't listed on the major exchanges are traded. Stocks and bonds that trade on the OTC market are typically from smaller companies that don't meet the requirements to be listed on a major exchange. An example of OTC trading is a share, currency, or other financial instrument being bought through a dealer, either by telephone or electronically. Business is typically conducted by telephone, email, and dedicated computer networks.
So I'm Jumay Manangit. I will be reporting both investment banking and traditional registration. So what is investment banking? Investment banking is a type of banking that organizes large, complex financial transactions such as mergers or initial public offer, IPO, underwriting. Now, there is a difference between investment banking and private equity. Here is the details. When you are investment banking, you need these 5 major factors, no? Mergers and acquisition, restructuring and reorganization, research, sales and trading, and raising capital. Now we are on to traditional registration. What is traditional registration? So, registration is the process by which a company files required documents with the Securities and Exchange Commission, or the SEC, detailing the particulars of a proposed public offering. The registration typically has 2 parts, the prospectus and private filings.
Topic is all about issue cost. So when you say issue costs are one-time costs that are incurred while raising funds by debt and equity financing for a project. As the name suggests, every company needs to spend money while issuing securities in the stock exchange. It is incurred while the IPS are raising debt from the market through insurance of securities. My topic is all about shelf registration. Shelf registration, shelf offering, or shelf prospectus is a type of public offerings where certain issuers are allowed to offer and sell securities to the public without a separate prospectus for each of offering and without the issue of further prospectus. The last topic is all about regulatory change. When you say regulatory change, it is the process of anticipating, capturing, and implementing regulatory change across financial service. Regulatory change arms in different shapes and sizes, form enforced, black letter, laws to software guidance, down to blogs and speeches. Publish regulatory content, regulatory change in one way or another, and financial institution must keep up.
Efficient market. Efficient market is the market which has the goods that are efficient to customers. So mo na siya efficient market sa mga goods nga efficient sa customers, bitaw na bitaw ug sige hanglanan nimo na sa market which is efficient market. Efficient market is the control of prices from other markets. So mo na siyang marutog suki bitaw nga plan ng na mas barato or pareho sila presyo tanan. So those are called efficient market. So efficient market have 2 aspects. So number 1, first one is a market is not questions by black or white, but gray about shades or gray. A market is not efficient but more efficient or more or less. Kana siya mo na siya market, murag lisod kay sa tunog, pero mo na siya ang dili na siya mapangutana og unsay black or white. Pangutanon na siya og unsay shades or gray, kung na shadean or na grayhan. So market a market is not efficient but more efficient or more or less. Mo na siya gitawag nga market nga na siya sa market karon, na siya sa lang tindahan karon, but sa other tindahan wala na siya. So more or less ang isa ka market nga para nang dako ay nga kumpanya which is have everything na, pero nagi uban gyud nga wala sa diha nga market. So mangita na buglang market. So that are mo na gipangita sa efficient market. So the second one is effectiveness is a master of perspective. So
efficiency is the market of perspective. So efficiency dapat kompleto ka. Efficient dapat ug dako og company, dapat ang company nimo imong market is efficient na tanan. Pero di mo malikayan nga mawa na tanan. So mo to siya. And second one is, what is efficient market? Efficient market is the hypothesis of financial economics that states the effect or the assets prices reflects available information. So mo ni siya ang yung lagi ganina lagi nga kung sa presyo sa uban may presyo nimo, syempre wala mamalit nimo kung mahal kay ka din ang uban barator kayo. So mo ni siya ang one sa ganito tawag na basta mao na siya ang mo reflect na siya sa imo ang market. So mo na siya efficient market. I-reflect nimo ang unsa sa nakauna sa imo reset ka. Mo na siya mirror. That's the mirror of efficient market. So that's what efficient market is. So God bless. Happy Halloween.
Have a wonderful day, Ma'am Naisa Lusud, and to anyone who could be able to see this video. So I will be going to report the topic, implications of efficiency, and the appendix. So first to discuss is the implications of efficiency. So it is stated here that if financial markets are semi-strong, efficient, the following statements are true. First, publicly available information is not helpful in forecasting future prices. So, ang kanang mga information na ato ang nadungog sa mga tao, kanang mga public information, mga walay assurance, mga nadunggan lang nato, mga chika-chika lang, inana, dili na siya helpful to forecast a future prices. So, dili na siya makatabang, dili siya advisable ang kanang public available information. Second, in the absence of private information, the best forecast of future price is current price, perhaps adjusted for a long run trend. So since nga dili man advisable nga maminaw lang ta or mag-conduct lang ta og public information, so ang ato ang buhaton is mag-conduct ta og private information. Mag-conduct ta og private information, mag-assign ta og isa ka tawo nga ma-auto siya magkuhag mga mag-gathered og mga information, mga sakto nga information. So in the absence of that private information, kung wala tay makuha nga information sa atong gi-conduct nga private informationer, ang the best lang nga buhaton is the best forecast of future price is current price. Ang pinaka the best lang nga buhaton is mag-stay ta sa ato nga current price. So stay lang ta sa ato nga current price. Third, without private information, a company cannot improve the terms on which it sells securities by trying to select the optimal time to sell. So kung walay private information, ang company dili siya makabuhat pag-improve sa iyang mga sales. Without private information, investors should not expect to consistently earn above the market average rate of return. So kung walay private information, ang investors dili siya mag-expect na mas dako siya makuha ang average rate compare sa nakuha niyang average rate before. So mao to siya ang mga true statement if the financial markets are semi-strong, efficient. Individuals without private information have two choices. Tonight, sila'y duha ka choices. They can reconcile themselves to efficiency and quit trying to forecast security prices. So, either magkasinapot sila to efficiency and quit trying to forecast security prices or maganda sila mas secured nga mga prices, or else they can attempt to make the market inefficient from their perspective. So this involves becoming a market insider by acquiring the best available information. Gathering variation, usually illegal, is to seek about events before others. So, a advanced knowledge that Carl Icahn will attempt to acquire, TWA, for example, on TWA, would undoubtedly be useful in forecasting TWA's future stocks. A third strategy some investors is to purchase a forecast of prestigious consulting firms. The chief virtue of this approach appears to be that there will be some to blame if things go wrong. So, mo to siya nga na ay kung naiina na nga sitwasyon na apoy kining ma-blame kung na ay murag something wrong nga nahitabo sa situation. After all, if the forecast were really any good, the consulting firms could make money simply by trading, thereby eliminating the need to be nice to potential customers. So, mao to siya ang topic sa implications of efficiency. So now, let us proceed to the appendix. Using financial markets to manage corporate risk. So, magamit ta sa financial market aron ma-manage na to ang mga corporate risky situations. In this appendix, we look briefly at the use of forward and option markets to manage certain business risks. The topic merits our consideration for 3 reasons. First, sharp increase in the volatility of foreign exchange rates, interest rates, and commodity prices in recent years have heightened corporate interest in controlling this risk. So, ang katong exchange rates, interest rates, o ang commodity prices, mas pasakon pa siya aron nga makontrol ang mga katong mga risky situations. Second, as companies make increasing use of forward and option markets to manage risk, it is important that executives appreciate what these markets can and cannot do to help avoid unexpected losses. So, para mas malikayan ang mga unexpected losses kanang mga wala nga mga possible income ba or unsa or what else. So, mas maayo nga ang executive, siya ang mas mo-appreciate, siya ang mas mulihok kung unsa ang angayan o ang dili angayan nga buhaton. So, third, the popularity of forward and options trading is growing rapidly among stock and bond investors. Sometimes, as a means of controlling portfolio risk, and other times as a potent alternative to a day at the track. The speculative appeal of the instruments discussed here has recently become painfully apparent to a number of large and otherwise sophisticated companies.
In this video, we're going to learn and understand. First is what is forward market. Next is difference between forward market and future market. And lastly is hedging in forward market. What is forward market? Forward market is the market where exchange of currency takes place on future date upon agreed price. The characteristic of forward market is kind of contract, a contract between two parties, a customer and a dealer. Currency in the deal. Forward contract are made in all major currency of the world. Cash flow. Cash flow between contracting parties takes place at the time of maturity. Quotation. Rates are quoted by the dealer with bid-ask spread. The rates are locked in for the entire period of contract. What is future market? The future market where exchange of currency takes place on future date at a specific exchange rate. The characteristic of future market is standardization in terms of contract size, maturity, and minimum variation in their value. Organized exchange. Future market contracts are traded in organized exchange only. Clearinghouse. Clearinghouse is the middle person for transaction in future market. Hedging in the forward market is a means to protect the exposure in the forward currency, interest rate, or financial asset. One of the example in forward market is dollar. The value of EMI receivable equals $DM 1 million.
Good day everyone, my name is Josini Ipostero and here's my report. When the capital is raised, the financial manager act as marketing manager, where their aim is to sell their products with its highest price, and they won't focus on the company name but they focus on the wants and needs of their investors for them to invest on it.